the price is lying because the real story is in the silver spread. And it's flashing the kind of stress that doesn't stay quiet for long. Not because somebody decided silver should run, not because a headline told you to feel bullish, because the plumbing is tightening and the market is starting to price the one thing paper can manufacture on demand: immediate deliverable metal. And if that pressure keeps building into the next calendar window, thin liquidity, roll mechanics, and positioning stress, then the next week or two won't be about opinions. It'll be about forced behavior. And later in this video, I am going to give you the exact checklist I am watching to separate a controlled retest from a continuation squeeze, plus the one signal that would tell you the whole thesis is breaking. Silver didn't politely drift higher. It snapped. It jumped ranges. It moved the way markets move when there's not enough real liquidity behind the quotes. One day it's chewing through levels like they don't exist. The next it's ripping higher in bursts, then whipping back hard enough to shake out anyone who's late and levered. That's not normal bullishness. That's stress, and that's where the real pressure starts. Because silver is not a big, deep ocean like major currencies. It's more like a narrow channel with a strong tide. When the tide turns, boats don't glide, they slam. Here's the problem with the mainstream explanation you'll hear. They'll tell you silver is just a shadow of the dollar, or just a leveraged bet on rates, or just a risk on commodity that runs when sentiment runs. And yes, those macro drivers matter. But they don't explain this kind of price action by themselves. They don't explain why the market feels jumpy at the front end. They don't explain why the move has that no air under it quality, where pullbacks are violent and recoveries are sudden. The next detail is what flips the whole setup. You have to stop watching only the headline price and start watching how the market is pricing time. Because in commodities, especially tight ones, time is not free. Time is a cost. Time is storage, financing, insurance, and the risk that the metal won't be where you need it when you need it. And when that cost structure shifts, the curve tells on the market. The curve is the confession. The cash price versus future price, the nearby contract versus the next one, the way spreads behave when the market is calm versus when it S stressed, that S, where you see whether this is a paper rally or a physical squeeze trying to form. Let me make it simple. In a relaxed market, the future is often priced a bit higher than the present. Not always, but often. Why? Because holding metal costs money. If I need silver today, I pay today's price. If I can wait, I am paying a price that reflects storage and financing and the convenience of not needing it immediately. But when the market gets tight, when immediate metal becomes hard to source, then the present starts to get more valuable than the promise of future delivery. And that is the hidden detail most people miss. When the spread tightens or flips in a way that says, I'll pay up for now, you're not watching emotion. You're watching scarcity get priced. Because if this one level breaks, the math changes. Now, I'm not here to sell you a bedtime story about guaranteed profits. Silver can rip your face off in both directions. It can punish bulls and bears in the same week. But that volatility is exactly why this matters. When the structure is tight, volatility isn't just noise, it's a weapon. It's how the market tests who's forced to act. And you need to know who is forced to act, because that's where the outsized moves come from. So let's talk mechanics, paper versus physical, without turning this into a textbook. Futures markets are brilliant inventions. They allow producers, refiners, and industrial buyers to hedge. They create liquidity. They let the world discover a price. But they also create a situation where an enormous amount of exposure can exist without an enormous amount of metal changing hands. That's normal. That's not evil. It's just how derivatives work. The trouble starts when the derivative market is making promises faster than the physical system can comfortably absorb, deliver, and settle. Then the market becomes hypersensitive to timing. Then the nearby contract matters. Then the spread becomes the heartbeat monitor. And that's not the part that gets tweeted. In the silver world, there is always this tension between the idea of inventory and the reality of usable inventory. You'll hear people toss around big numbers, total vaulted metal, total exchange stocks, total ETF ounces. But here's the real world question that actually moves price when it gets tight. How much of that metal is immediately available, deliverable, and unencumbered at the moment the market demands it? Inventory that's pledged or earmarked or sitting in the wrong place, or held by someone who has zero incentive to sell at today's price. Functionally, that inventory might as well be on the moon. It exists, but it doesn't clear the market. And when the market realizes that, it doesn't announce it with a press release. It whispers it through spreads, premiums, and delivery behavior. So what's the supply side doing? Here's where silver gets uniquely stubborn. Most silver doesn't come out of the ground because a miner woke up and said, let's mine silver. A big chunk of it is byproduct. It rides along with lead, zinc, copper, and other base metals. That means silver supply is chained to the economics of those other metals, to the throughput of those mines, to the capacity of refineries, and to the timeline of projects that take years, not weeks. Even if silver price explodes, you don't flip a switch and get a flood of new silver next month. The supply chain has inertia, and inertia is calm until demand hits it like a wave. Now stack demand on top of that. Silver is not just a metal for doomsday stacks. It's also a working industrial material, electronics, electrical contacts, solar applications, specialized alloys, medical and chemical uses. And the key detail in industrial demand is this: a lot of it is not discretionary in the short run. If you're a manufacturer and silver is a small component of a high-value product, you don't shut down your line because silver went up. You try to source, you pay up, you hedge, you sign contracts, you pull forward orders. Procurement people don't get rewarded for timing the perfect bottom. They get rewarded for not being the reason production stops. And that's where the pressure starts. Here's a street-level symptom you can watch without any fancy terminal. When physical tightness is real, the market's tone changes. Dealers stop advertising size. Premiums get sticky even when spot pulls back. Delivery windows quietly lengthen. People who normally say, no problem, start saying, we'll see. And none of that shows up in a clean headline, but it shows up in behavior. And behavior is data. Because if you can't easily replace metal, you don't easily sell metal. Now add the institutional layer. You have ETFs and custodial holdings that can be a sink or a source. You have funds that allocate based on momentum, volatility, and correlations. You have systematic strategies that buy when trends strengthen and sell when they break. And you have macro money that treats silver as a high-octane way to express a view on inflation, real yields, and currency stress. When those flows start leaning in the same direction at the same time, you get reflexivity. Price rises, flows increase, hedges shift, and the system has to adjust. But that adjustment doesn't happen smoothly. It happens through the market makers and hedgers who are forced to rebalance. And that's where the real pressure starts. Let's talk about that forced rebalancing, because this is where people get shaken out. When a market moves quickly, the participants who are short, whether they're speculators, hedgers, or liquidity providers, start taking heat. If they're levered, margin requirements rise. Their brokers demand more collateral. Their risk teams tighten limits. And in commodities, those changes can be sudden. A short can be fine until it isn't, and then it's not a debate. It's a liquidation. That's the short covering mechanic. You buy because you must, not because you want to. And forced buying is the kind of demand that doesn't negotiate with price. But here's the twist that matters in silver. You can have a situation where paper shorts are comfortable as long as the curve is comfortable, as long as rolling positions forward is cheap, as long as spreads behave, as long as there's no penalty for pushing delivery into the future. But when the curve tightens, when the nearby becomes expensive relative to the deferred months, that roll becomes painful. That's when the math changes. If it costs you more to stay short, you either pay up, reduce exposure, or scramble for a hedge elsewhere. And that's when the spread tells the truth. The price might look overextended. The narrative might say it's due for a pullback, but the structure can keep the pressure on longer than people expect. And that's not the part that gets reported. Now we need the why now. Why does this matter this week, this month, right now? Because commodity markets don't move in a smooth, calendarless vacuum. They move around deadlines, expiries, roll windows, and liquidity holes. There are moments when participation thins out, weekend gaps, holiday liquidity, month-end positioning, quarter-end risk reduction. There are times when large funds rebalance exposures. There are times when hedgers roll contracts. And there are moments when a market that's already tight gets nudged into a scramble simply because the calendar forces action. This is the part where retail gets emotionally manipulated. You'll see it over and over. Price rips higher, social feeds light up, late buyers chase, then price snaps down in a brutal flush. People panic. They call the top. They dump. And then the market stabilizes and grinds back up, leaving them behind. Or sometimes price keeps flushing because the move really was a blow-off. The point is not to pretend you can predict every tick. The point is to protect yourself from being harvested by the volatility. Because even if the thesis is correct, the path can be violent. And volatility is how the market tests conviction and forces the weak hands to hand over inventory to the strong hands. That's the game. So how do we separate a real structural squeeze setup from a hype spike? We build a proof stack. Not one argument, not one chart line, 5 layers minimum. Mechanism, structure, real-world symptoms, cross-market comparisons, and then a roadmap with invalidation. That's how you earn trust in a market that's designed to break it. Proof point 1, term, structure, behavior. You don't need to be a spreads wizard to grasp the message. If the market keeps paying up for the front end, if the nearby stays firm relative to the next month's, that's a sign of urgency. That's not a guarantee of higher prices tomorrow, but it's a sign of tightness. And if that tightness persists through pullbacks, it tells you the demand for immediacy isn't going away. But that's not the part that matters by itself. The next detail is what flips the whole setup, the curve S behavior around key calendar windows. Proof point 2, inventory usability versus inventory optics. When people quote total holdings, ask the adult question, what portion is actually able to satisfy the market S delivery needs without a fight? If stocks exist but aren't offered, tightness can still build. If metal is vaulted but tied up, tightness can still build. If the market relies on metal moving from one place to another, logistics can become a bottleneck, and bottlenecks create premiums. And premiums create arbitrage incentives, and arbitrage is a magnet. This is where the plumbing connects to price discovery. Proof point 3, physical premiums and availability behavior. Again, no fake precision. You're looking for directional signs. Do premiums collapse on pullbacks, or do they stay annoyingly sticky? Do dealers suddenly have limits on size? Do delivery timelines stretch? If the paper price drops, but physical doesn't loosen, that's a signal. Because if this one level breaks, the math changes, either toward a clean reset or toward an even sharper squeeze when paper tries to reassert itself. Proof point 4, cross-market and cross-region comparisons. Silver doesn't trade in one silo. There are different hubs, different vault systems, different flows. When a market is tight, regional premiums can diverge. The price of a promise and the price of metal in hand can separate. Arbitrage tries to close the gap, but arbitrage takes time. Metal, paperwork, logistics, and financing. That time delay is where volatility lives, and that's where the real pressure starts. Proof point 5, positioning and the behavior of leveraged participants. You don't need confidential data to understand the mechanics. When a move is sharp, someone is trapped. When pullbacks are violently bought, someone is defending. When rallies accelerate late in the day, someone is being forced. When the market stops caring about overbought, it's usually not because everyone suddenly became irrational. It's because the risk management clock is ticking for someone. And if you're a retail trader trying to outstare a margin clerk, you're not trading the same game. Now, let's address the counterpoints, because this is where the skeptics are right to be skeptical. Silver is famous for false starts. It can print a breakout and then snap back below the level and make everyone look foolish. It can run on speculative heat and then cool off the moment the macro wind shifts. If real yields spike, if the dollar catches a bid, if risk assets unwind, silver can get dragged down even if the longer-term story is bullish. And if the move got too steep too fast, you can absolutely see a sharp correction. Markets don't move in straight lines. They punish certainty. That's why your plan has to include what would weaken or invalidate the thesis. Because the only thing worse than being wrong is being stubbornly wrong, while volatility is charging interest. So here's the two-scenario lens, clean and simple, so you don't get hypnotized by intraday noise. Scenario 1 is the controlled pullback and retest. Price cools off, the market shakes out late chasers, it revisits prior breakout zones, it wicks lower, scares everyone, then stabilizes. The key is not that it can't drop, it can. The key is how it behaves when it drops. Does it find buyers quickly? Do spreads stay relatively tight? Do physical indicators stay sticky? If yes, the structure is still intact, and the market may be setting a higher low. That's the kind of retest that resets momentum without breaking the thesis. But that's not the part that matters. The next detail is what tells you whether it is a reset or a fracture. Does the market regain the breakout zone with urgency, or does it chop weakly underneath? Scenario 2 is the continuation squeeze. Price doesn't give you the clean retest, it chops briefly, then snaps higher again. It gaps through levels when liquidity thins. It forces more covering. It triggers trend-following flows. It becomes one of those moves where you wake up and the market is already somewhere else. This is where people get emotionally manipulated the opposite way. They see it run and they feel regret. They chase. Then it whips. Then they get angry. Then they do something reckless. The right mindset here is not, I must catch every dollar. The right mindset is, I must survive the volatility while the structure reveals itself. Because if this one level breaks, the math changes, either toward exhaustion or toward a larger repricing. Now let's get practical. What do you watch next week and the week after, when the talking heads are loud and your feed is screaming? First, watch the prior breakout zone as a range, not a single magic number. Markets don't respect your ruler, they respect liquidity pockets. If price revisits that area and finds buyers quickly, that's constructive. If it slices through and cannot reclaim it on a bounce, that's a warning. Not a death sentence, but a warning. Because reclaiming levels is what trends do. Failing to reclaim is what bull traps do. Second, watch the daily range behavior. In a healthy trend, volatility can be high but directional. In a fragile move, volatility becomes chaotic and mean reverting, with huge wicks and no follow-through. If you see massive intraday spikes that immediately reverse and then stall, that's distribution behavior. If you see pullbacks that are bought quickly and then consolidated above key zones, that's accumulation behavior. This is not fortune telling, it's reading who is in control of the tape. Third, Watch the curve and the spreads. You don't have to memorize every contract month. You're simply asking, is the market paying up for immediacy, or is it relaxing? If the front-end tightness eases dramatically while price is still high, that can be a sign the squeeze pressure is venting. If the front stays stubborn while price dips, that can be a sign physical urgency remains, and paper is just shaking out weak hands. And that's where the real pressure starts. Fourth, watch the real-world symptoms. Do premiums and availability behave like a market that's loosening, or like a market that's still tight underneath? If physical remains firm while paper whips, that tells you something about who's actually constrained. And if physical suddenly loosens while price is still elevated, that's a sign the supply chain may be catching up, or demand is cooling. Either way, it's information you can use. Fifth, watch the macro backdrop, but don't let it hypnotize you. Rates, inflation expectations, currency moves, geopolitical risk, these are the weather systems. Silver is the terrain. Sometimes the weather dominates. Sometimes the terrain dominates. Your job is to know which one is driving the move right now. If silver is rising while the usual macro headwinds are present, that's a stronger signal that something structural is happening. If silver collapses the moment the macro wind shifts, then the move may have been more speculative than structural. The next detail is what flips the whole setup, whether the market can hold key levels when the macro backdrop is not helping. Now, I want to talk directly to the part of your brain that gets tricked by volatility, because this is where most people lose even when they're right. Well, they buy because they're excited. They sell because they're scared. They re-enter because they're angry. And all of that happens inside a range where the larger structure never changed. Volatility is not just price moving. Volatility is a narrative machine. It manufactures certainty at the top and despair at the bottom. It makes you feel like you're missing out, then makes you feel like you were stupid, then makes you feel like you must make it back. That's how you get harvested. So here's your shield. First, separate trend signal from noise. Trend signal is structure. Higher lows, reclaimed levels, supportive spreads, persistent physical firmness. Noise is intraday drama, wicks, headline spikes, social media panic. Second, decide your time horizon before the market decides it for you. If you're watching a thesis that plays out over weeks, don't let a 2-hour flush bully you into an all or nothing decision. Third, respect the possibility that you can be right about direction and still get ruined by leverage. If you can't hold through a normal pullback without panic, your position is too big. That's not an insult. That's risk math. And here is the part that often gets missed in silver. The market loves to weaponize gaps, thin liquidity moments, overnight moves, weekend surprises. These can create instant regret or instant panic. That's why you plan for 2 scenarios instead of 1. Scenario 1, you get a pullback and a retest. You don't need to chase. You watch structure. Scenario 2, you get a continuation squeeze. You don't need to FOMO. You watch confirmation. Either way, you refuse to let the market pull you into impulsive decisions. Because if this one level breaks, the math changes, but your discipline shouldn't. Now, let EOS bring it back to the core claim. Supply chain tightness plus structural signals are creating a setup where paper can easily bully physical, and the curve is hinting at urgency. That doesn't mean the market goes straight up. It means the market is vulnerable to outsized moves when it is forced to reconcile promises with availability. The people who dismiss this as just another silver spike are looking in the wrong place. They're watching the headline price like it's the whole story. But in commodities, the story is in the constraints. The story is in the cost of time. The story is in who is forced to act. So what would confirm the bullish structural thesis in the near term? You see pullbacks that defend the prior breakout zone. You see rebounds that reclaim quickly. You see front-end tightness that doesn't collapse. You see physical symptoms that stay firm. You see the market refusing to give bears the clean breakdown they're waiting for. That's confirmation. Not one candle. A pattern of behavior. A pattern of pressure. And what would weaken or invalidate it? You see the market break below the key breakout area and fail repeated attempts to reclaim. You see spreads relax sharply, meaning the urgency is gone. You see physical premiums and availability loosen meaningfully, meaning the supply chain is not stressed the way it appeared. You see volatility turn from directional with shakeouts into chaotic with distribution, where every rally is sold and every bounce dies quickly. That's not the end of the world, but it changes the setup. It tells you the market may need more time or that the move was more speculative than structural. And if that happens, you don't argue with it. You adapt. Because the market does not reward stubbornness. It rewards alignment with structure. One more thing before we close, because this is where smart viewers separate themselves from the noise. Don't let anyone shame you into certainty. If you're bullish, you still respect downside. If you're bearish, you still respect squeeze risk. Silver is a market where obvious can become expensive in a hurry. It's a market where positioning and tightness can flip a calm day into a scramble. It's a market where the right call with the wrong sizing becomes the wrong outcome. So keep your ego out of it. Keep your plan in front of you. Keep your eyes on the plumbing. And here's the subtle CTA, because I am not interested in begging for clicks. I am interested in building a room full of people who done T get played. If you're the kind of investor who wants mechanisms, not slogans, who watches spreads and structure instead of chasing the loudest headline, then you're already part of the right crowd. Stay close. Keep comparing notes. Because the next week or two in silver won't reward the loud. It'll reward the prepared. Now, final checklist. 2 scenarios: clean execution, no drama. Base case, controlled pullback and retest. Price cools, revisits the breakout zone as a range, holds it, and then climbs with steadier footing. Your watch items are support behavior, reclaim speed, and whether the curve stays firm. If it holds, the market is resetting for the next leg. Squeeze case, continuation with gap risk. Price chops briefly, then launches, forcing covering and triggering systematic flows. Your watch items are range expansion, failed sell-offs, and persistent front-end tightness. If the curve stays tense and dips get bought aggressively, don't let your emotions write your trades. And the one metric everyone must watch, the hidden detail that keeps telling the truth, even when the headline price tries to deceive you, is the structure of time, the spread, the curve, the urgency embedded in the front end. Because when the market is calm, time is cheap. When the market is tight, time becomes expensive. And when time becomes expensive, paper promises stop feeling infinite. That's the setup. That's the risk. That's the opportunity for those who can think in mechanisms instead of memes. And if the next calendar window hits with thin liquidity while this structure stays tense, don't be surprised if silver doesn't just move. Don't be surprised if it lurches. Because if this one level breaks, the math changes.